Hey, welcome back to Fully Invested Fi Labs. It's been a minute. Just as a reminder, this channel going forward will just be covering my retirement accounts. My main channel, Fully Invested Fi, that just covers my main taxable brokerage. And this side channel, idea is to cover any retirement accounts, just because it's pretty different. And I notice that people are pretty split between that. And in case there's ever any strike shenanigans, like I might maybe just post temporarily here, but going forward will just be about my retirement account, potentially my mom's too, still kind of working through some details there, but this is Fully Invested Fi Labs. And yeah, I don't know, maybe it's even worth like doing a little bit of a rebrand, given that I'm not just posting main channel stuff anymore, as test is maybe outdated. So I'll have to think through that, but welcome back. Yeah, so I put out a poll a couple weeks ago to see what video you were interested in seeing. And by a decent margin, the how and why I introduced light leverage into my retirement accounts won out at 58%. So my follow-up video will probably be like what my early retirement plans are at 40 years old. And so it'll just be a lot of those kinds of videos on this channel, right? So it'll be a lot more softer, a lot less like, yeah, not just purely based on the accounts, could be just retirement thoughts and things like that. But let's just dive into this topic today. As usual, just a quick disclaimer. This video is for entertainment and education purposes only. I'm not a financial advisor, and nothing here should be taken as financial investment or tax advice. I'm simply sharing my personal investing journey and documenting my own results. So make sure you have a good read of this whole disclaimer. So if we pop over to Robinhood, so this is the individual account, that's for other channel if you're ever interested, but yeah, definitely a red day today. But we're not going to be focused on this channel today. We're going to check on the retirement accounts. So if we pop over to the retirement tab, can kind of take a quick look here. So I have two accounts, right? So I have my Roth IRA here, so down a lot today. You can see that it has blocks, IBIT, T, and then traditional IRA, 153.9K, and has VGT, SPMO, TQQQ. And the TQQQ and TSCL portion is what I want to focus on today. And so kind of what prompted me to even think of introducing leverage to my retirement accounts. If we pop over to Miro, it was actually this one comment that happened several months ago, just because I was kind of rebalancing things in my retirement accounts, right? And then I had BTCI at the time in my Roth IRA, and just because I wanted some Bitcoin exposure, and I don't know, my way of kind of keeping Bitcoin still there and still kind of collecting income while there's drawdowns was doing an income one. And some random person just mentioned sell BTCI and buy UPRO, and randomly that just kind of stuck with me. And I think I remember taking a quick look to compare it to like BTCI and UPRO. If I just did a quick example here, just BTCI, UPRO. And I think those results kind of like always stuck with me. I was like looking at it, I was like, okay, that could be interesting. And then even if we compare it to like IBIT, and so I was just like, okay, that's something. But it just stuck with me in the back of my head. And then also given that how much margin I'm using just in the taxable, like I could see the benefits of potentially using a little bit of leverage in the retirement accounts. I kind of just mulled over in my head. I saw a bunch of different videos about it over time. And then like even like one channel that like particularly stuck with me is Enrique's Wealth Academy. He just goes super hard on leverage ETFs. And yeah, he has a lot of content that covers it. And he brings up some good points in it that like I checked out the math for myself and checked out backtests and whatnot. And he doesn't by any means encourage people to go all in. He does it only for a portion of his portfolio. But that's something I hadn't considered, because originally what I was thinking about was I was like, oh, like, should I potentially just like full port into like, say, a 2x fund instead of 3x, and then just kind of keep that for the long term for 25, 30 years, not touch it, and collect it once I hit retirement. But then when he was mentioning, yeah, just doing a certain percentage, that made a lot more sense and felt more like as a better asymmetrical bet in that way. So I kind of just dove in after that and just kind of checking like little back tests for everything. And we can actually dive into some of these. If we check, for example, this first one. So this is my old VGT SPMO split, right? I had 75% VGT, 25% SPMO. And then I was kind of toying around with the idea of like, what if I did 10% in TCL ever since basically SPMO came out before 2016 here. And had I done that and I had like 160 at the time or whatnot, there'd be quite a market difference here, like $500,000 difference here as far as just introducing 10% of the portfolio into like a 3x fund. So you can kind of see here how like the CAGR, yeah, just goes from 22% per year to 25 just from that little portion. So you kind of get outsized returns for that. And the beta is like a little bit higher, but not too crazy. Right? And after I was kind of checking, for example, just raw between TQQQ, TCL is a little bit more focused in tech and semis and things like that. So it's a little bit more volatile than TQQQ, but a lot less AUM against QQQ, VGT, UPRO. And this one was interesting just because like this goes further back, like right after basically the financial crash. But you can see like the difference is kind of crazy, right? As like long-term holds. So TQQ and TCL here, you can see that like its CAGR is like quite a bit more, right? And that's a hell of a difference. And it's a lot more than just 3x the return. It's like if we calculate that out, like 30,763% divided by 1699. That's like an 18x difference. And I mean, the leverage, it makes sense because it's like it just compounds, or like same thing as like a compound interest. So on the upswings, it compounds quite a bit. Of course, it's a lot more volatile. Beta is way higher, over 3 times. But I don't know, seeing this honestly kind of convinced me that it's like, it could actually work as a long hold. Like I know conventional wisdom for these leverage ETFs is typically to just kind of use these as like swing trades and things like that. But if I'm considering using it for 25, 30 years and not touch it and just not worry about the volatility as much, and kind of see that it could work out, right? And even like the biggest thing is like people might mention that like, oh, if you do it in right before a crash, right? And I kind of wanted to model that out as well too. So here I kind of basically capped this to basically right before the COVID downturn in March 2020. And like, I mean, you definitely see that. So this one fell a lot more compared to the rest because of the leverage. But in the end, like as things upswing, it's definitely still held up good. It's maybe closer to like a 2x return here versus like the 18x that we saw. But over time, if we hold that, and if you think the markets will keep rising, which I think will for the US market specifically, these are still higher. So kind of see here compared to where would do versus TQQQ, like almost double here. TCL against VGT a lot higher as well, and then I just put UPRO here for good measure just to see where it would be. So even this is right investing into leverage ETFs right before a big crash, right, for COVID. So, but my idea there is that like, yeah, I'm just gonna have it as a long hold and just let it do its thing for 25, 30 years because I'm hoping to only touch its money at like 59.5. So that's like 24 years from now. So that's a lot of time to kind of just let the things do its thing. Or even here, this is just like 10 years. And yeah, you can kind of see the difference, right? That's like a $500,000 difference just from 10% of the portfolio being into a leverage ETF here. So, and this is in TCL. So these numbers made a lot of sense for me as I saw it. And then that's what kind of prompted me to actually put 10% of my portfolio into leveraged ETFs here. So not full portfolio into like a 2x one like I was thinking. And like I know too that like long term, there's been research that says that like, yeah, 2x might be more sensible as far as the optimal leverage to use over a long period of time. And it's kind of, it ebbs and flows over like kind of periods of years, but 2x generally seems to be best case there. But given that I'm only doing 10% of my portfolio and an asymmetric bet, like I think I'm okay with doing the 3x leverage for that. And even one thing that's interesting too, that if we look up TQQQ ETF as well, if we look up like the 2022 tech downturn, so this went down quite a bit. You can kind of see here, almost 70%. So tech was down 32% that year. But this actually didn't go down like 3x. So it doesn't quite work out to 3x all the time. There's a daily reset on these. And I know there's some funds too that have like quarterly or even monthly. This is daily where the leverage resets. So sometimes there are some like upswings. So that kind of helps insulate it from kind of being a fully kind of 3x return on that year. But that's kind of like why after seeing all those numbers, I was kind of convinced to just kind of give it a long hold in my portfolios. So here you can kind of see in my traditional IRA. So this is kind of like rollover IRAs from like different jobs over time. So I basically took 10% of VGT and then put that into TQQQ here. So of course, right now, the market is taking a big hit in tech and in semis. So this has kind of gotten hit quite a bit. So this is actually down like 18%. So you kind of really see the leverage biting you there. So my plan for this is really to, any dividends that I receive from VGT, TQQQ, or SPMO, I'll probably just be reinvesting it into TQQQ going forward, especially if it's red. If not, maybe I might reinvest it into others. So you really see that's only like 10% of my portfolio here. Oh, and actually my allocation here is totally busted. Let me fix that really quick. So my allocation actually has dipped down a little bit here because of the dip, right? But it's definitely a small portion of the portfolio. And then over here as well. And here on the Roth IRA, the TCL, that's really just like 4% right now. So what I've been doing is that anytime I get my weekly blocks dividends, so I basically replace BTCI by blocks. I've been just reinvesting the dividends into TCL, especially as it's been low. And for my Roth IRA too, I haven't contributed the 7,500 this year yet. I was debating whether I would or not, but I think I might. And it might be a thing too, honestly, where I just pull out cash from the main brokerage and put it into the Roth IRA. And it's almost kind of like emergency fund, just because like you can always pull out your contributions tax-free and penalty-free in your Roth IRA, which is nice. So I kind of treat it that way. And that I wouldn't necessarily put into the leverage ETF. I might put that into VGT potentially or something like that. And I'm just mostly focusing on growth in these retirement accounts. I think the exception here is like kind of blocks and IBIT here, but this is kind of lumping Bitcoin together. I think like for me, at least I've found that especially with Bitcoin, with how volatile it is and how down it gets, it is nice to kind of get that income to like kind of cushion things. So I swap BTCI for blocks for better upside, and then the dividends I'll use to reinvest. And I was doing IBIT for the longest time. So there's like $1,000 in IBIT right now, or we can just see it here, really just under $1,000. And then I've been mostly focusing on adding those dividends to TCL now. So whenever there's an upswing here, should be nice between blocks and IBIT, but crypto's down obviously for a bit. But that's how stuff is broken down between my retirement accounts now. We'll be sticking to that. And the idea is to just kind of do this for 25, 30 years. If I don't end up quite pulling out like right at 59 and a half. But yeah, I think 24 years should be a good run to kind of just let the leverage ETFs do its thing here. Again, I'm not full porting this. I'm really just doing 10% of my portfolio. So keeping it minor. Over time, if I see it's like really working, like I might maybe add more, maybe do a 2x instead or something, like add different positions there. But just it is interesting to see. And just because like you really see like the compounding effect, and then yes, it goes down quite a bit. Like these are like 80% drops, right? This is like nothing to sneeze at. But yeah, you can see because of the compounding, it can really push it up, and it's still higher than like whatever was in kind of QQQ VGT, right? You really see the big difference in compound interest there. So that's where I'm sitting for retirement stuff. And one thing to note too, like right now I am not, so you'll notice that this over here, this is my little position in my work 401k. So just an S&P fund. But yeah, I stopped contributing to this a few months ago just because I realized that any contributions I make in my first year of employment doesn't get matched. It only starts getting matched after 1 year of service. So I actually paused it, and I'll resume it whenever I hit my 1 year in April next year. And so any extra money that would have been going towards that, I'm just kind of investing that in the taxable for now. And then I do have my HSA as well too. And actually, as of today, this is going to be 2,100, and then I'll be able to actually unlock investing for it. Because what I've been doing is just paying everything out of pocket. And then also when I invest my HSA, and then the idea behind this is to really use this money in retirement for any medical purchases and things like that. But my hope is for if I hit early retirement, like I'd either pay for medical insurance myself off market, or would potentially just go on my spouse's medical insurance at her job. So that's the idea there behind the HSA. So a lot of different vectors that I'm kind of hitting the retirement from, like, yeah, just kind of simpler funds here, Bitcoin and leverage, and then also just the HSA. So it's not just my taxable, right? I have quite a bit in the background that's growing as well too. So between all that's like 163.7K. And just as a reminder as well, so I'm employing a little bit of like a two-pronged strategy for early retirement, right? So for my taxable, I'm basically just trying to handle early retirement between the ages of 40 and 60, or yes, 59 and a half, call it 60. So there's a 20-year gap that I'm trying to fill with my taxable brokerage. And then after that, once I hit 60, then my retirement account will kind of take the baton, right? So I have my 401k and then my Roth. And these were the old projections based on when those were split between just even SHD on the 401k, VGT and things like that. So actually you need to run an updated projection for fees, right? So at least specifically for the 401k, because this one will get a lot higher given that I got rid of SHD since this one projection. So yeah, after 25 years, I was looking towards being at 1.2 million in that account, right? But now that we have, 65% VGT, 25% in SPMO, and 10% in TQQQ. Let's actually change this here. So we can kind of look at what it's doing. So this would be a 25.11% CAGR. And then let's go to the market beat calculator here. So starting principal here, right now we're at 54,130. Dividend amount, there's not really much. Let's just call that 0% for now for these purposes. Zero annual contribution. Expected annual share increase, like let's do 25% here. And then years invested, let's call it 24 since I'm 36 right now. And let's see. We'll see if this actually pans out, but supposedly if we keep up that 25% CAGR, that'd be like a 32.6 million ending balance, which is kind of crazy to think. So just gonna kind of keep that for a long hold and just let those ETFs do their thing, right? And leave them unbothered. So quite a bit of a difference. And even here, like this is what the 24 years was looking at for when I had like, I think the split was SCHD and VGT essentially before that I had. Like I think I had 75% SCHD, 25% VGT. So you can kind of see how SCHD would really drag things down. So that would be 32.6 million. It feels crazy to even write that, but so that, and then for my Roth, that one's a little bit trickier, right? Let's see if, just because like BTC and all that are kind of newish. So there's not gonna be too much history there to kind of get the CAGR. Let's see what kind of CAGR it gives us here. My split right now between all of those is 81%, 4 and 13. Let's just call it 83 here, just so it's 100. Yeah, so the CAGR here, like because Bitcoin has been on a down, it's like kind of irrelevant there. So can't really calculate for the Roth right now. I guess what we could potentially do is if I do, let's just do BTC here instead. Let's say since 2021 when I started investing. Okay. So this seems a little bit more realistic here. So let's say 18% CAGR for the Roth IRA. So 18, let's call it 18%. Right now we're at 6.7. This number changed quite a bit, right? Since last time I calculated this. Let's just zero this out. And let's do 24 again here. So right now, given that this has gone a lot smaller, I think last time I calculated this was like 18K. Ending balance 355.8K after 24 years. I may still contribute to the Roth, so that might even get even better. But so 355, so 0.355 million. So the idea is that like once I reach 60, would kind of like plus these two up. And then so this would be just about 33 million potentially. It's hard. I have a hard time even believing this number if the other one actually holds up with that CAGR. But like, yeah, and then after that, I'd kind of put this into a safer yielder. So something like a 10% yield. So that would be quite a bit if that ends up being a thing. So that would be 3.3 million a year. So I probably could even do like a 4% at that point. Like it could be even safer. But that's the plan there as far as like the retirement accounts. So I can see there how those numbers might work out. Definitely a lot more on the 401k, especially since that change that I made from SCHD VGT to SPMO VGT, and then now even that 10% of TQQQ. So that's kind of what I'll be doing. If there's any more updates on this, I'll definitely put out an update video. But as far as the next video, definitely look forward to this one. This one will be a little bit more of like a more soft retirement stuff, musing a little bit about what I'd do in early retirement. This will be fun to break down because I think about this a lot, honestly. And I know like people like Rob at Velocity Portfolio has done videos on this before, and that was really cool to see and hear his plans. So I was definitely thinking that I'd want to share mine too. And it's not quite what you're thinking. I'm not fully going to be done working. It's just that I'll be done working in my industry now, where I'm feeling pretty done with it overall. After, by the time I'm 40, that'll be like 21 years in the industry that I'm in, right? So yeah, looking forward to sharing that as the next video. It might be a couple weeks. I'm not gonna have a set cadence for this channel, keeping it more loose and a little bit less scripted than the main channel is at times, especially for the intros. So that's Fully Invested Fi Labs. Again, if you appreciate all this transparency, either on my taxable and my retirement, give a like and subscribe. And as usual, if you want to support the channel, check out the description below in any video. You have all my free and paid links, and that's the best way to support the channel. I'll catch you in the next one.